Hello and welcome to today's lesson. We will be looking at portfolio construction. What is a portfolio? It is simply a combination of securities. Now, the process of blending broad classes together broad classes of securities, of course, together to obtain an optimum return with minimum risk is called portfolio construction. Make note of the word broad classes. So you're blending these broad classes from different industries in the market of securities from different industries in the market, blending them together so that you maximize your return and minimize your risk. That is what portfolio construction is. Diversification of investment helps spread risk over many assets, of course, because security prices do not move exactly in the same direction. So some may perform as expected, but others may exceed expectations. So when you combine these two results, they move the portfolio results closer to the anticipated results. So when you've diversified, some securities are of course going to perform lower than your expectations. Some are going to perform better than your expectations. So you combine the two results together and it moves the general portfolio result closer to the anticipated results. A single security, of course, has greater likelihood of differing from the expected result. If you have a certain expected return from a single security, it may perform poorly or it may perform better. So when it performs poorly, it has moved from the expected results, and that's it. Like there's nothing else you can do. That is why diversification is very, very important. So we will look at the principal portfolio objectives. The first one is what are the objectives? What are we trying to get to achieve through this portfolio? The first one is growth-oriented portfolios. Now, this kind of portfolios are long-time price appreciation, which leads to increase in value. These are the portfolios that will give you long-term price appreciation, of course, leading to increase in value. The second one is income-oriented portfolios. These portfolios focus on current dividend payments and interest returns. So while you're constructing this portfolio, your focus is on current dividend payments and interest returns. So you're going to put in securities in this portfolio that are known for paying dividends regularly. Others include, but they're not limited to this. These are just examples. The others include to secure current income. So you might build a portfolio with the aim of securing current income. You might build a portfolio with the aim of achieving growth in income, not just securing it, but increasing it. Yeah, you might be looking for capital appreciation or preservation of capital. Okay. Now let us look at how to construct a portfolio, having in mind the objectives that we've talked about. The first one is current income. So what is the asset mix of current income, if current income is your objective? So you should go, if current income is your objective, you should go for 60 to 40 debt and equity split. 60 debt, equity 40. Okay, so you go for this equity, a 60 to 40 debt and equity split of investment instrument. Short-term debt and fixed income securities provide the income. Let me give you guys an example. So you have 3 to 6 months certificate of deposit, and then you have bonds with semi-annual and annual coupon payments. So you as an investor, you will have income on 90 days, from the 3 to 6 months CD, 180 to 70 and 365 days cycle basis. So at least you know after every 90 days, 180 days to 70, 365 days, you have an income. So if current income is your objective, then go for that 60 debt to 40 equity split of investment. The second one was growth of income, asset mix. If you're looking for growth of income, if your objective is growth of income, how do you mix your asset? Here you should opt for 60% to 100% equity, or 0 to 40% debt. Okay, if you can do 0% debt, good. But make sure it's not above 40%. Why is this? Because equities provide the best income growth avenue. That is basically it. If you want to grow your income, have a 60 to 100% equity or a 0 to 40% debt, because equities, they provide a better, not even a better, it's the best income growth avenue. Now, if you're looking for capital appreciation, what is the asset mix? So capital appreciation means that the value of the original investment increases over the years. Okay, so you have these funds that you put in this investment vehicle. You want that value to increase over the years. What do you do? Where would you invest to make sure that this happens? Investing in real estate, like land and houses, provide a faster rate of capital appreciation. So this is like the best. Real estate, for example, land and houses, it will provide a faster rate of capital appreciation. Although remember, you might have liquidity issues, okay? The second option for that, something else you could go for, is the stock markets. That also provides capital appreciation, but not as much as real estate. So although whatever stock markets take care of the liquidity issue. So this is something you have to consider and ask yourself as an investor, what is more important to you. So if capital appreciation is more important, invest in real estate. The other goal or objective could be safety of principal. What is the asset mix? What do you go for if you are concerned about safety of principal? This is a concern that every investor has. You can invest in, a certain investment vehicle, a certain venture, and you lose all your money. So it is a concern that every investor has, but it is a concern that, bothers some more than others, depending on age and temperament. So when you're young, of course, you have the chance, you have the time to be a little bit riskier, to be a risk taker, yeah? So maybe safety of principal could not bother you as much as a person who is looking to retire in 2 years. You don't want to be losing money while you're retiring in 1 year, 2 years, a few months, yeah? So if you are more concerned about the safety of your principal, the safety of your original investment, opt for less growth shares and go for more of debt and mature steady shares. Okay, so for example, if you could invest in more safe ventures like government bonds, and you could go for companies that are mature. They're companies whose share prices don't change that much, so they are companies that have very steady shares. They are very mature. You should opt for those more than growth shares. There are companies that are growing, so the prices are fluctuating. 1 month the price is this, and then the next month it's that. So if, depending on your concern, how concerned you are being about the safety of your principal, you put that into consideration. So if you're more concerned about the safety of your principal, the safety of your original investment, you go for more mature, more steady shares, and then you avoid the growth shares. And you could also go for debt investment. And that, guys, is how you would consider to construct your portfolio. Thank you so much for watching. Please give the video a thumbs up, leave a comment down below, let me know what you think, and please consider subscribing to our channel. Thank you. Bye bye.